Hey, hello friends. I'm sure when you have come to this topic to see this video, you are actually interested in knowing about investments, portfolios, mutual funds, and whatever it takes to earn money online, from your home, or whatever way. So today I'm here with an interesting topic of portfolio diversification. What are the needs, what are the benefits of having a diversified portfolio? So welcome to Finvest IQ. My name is Deep, and let's start with this exciting topic, which will definitely help you going forward in or optimizing your return in stock markets or your investment or in your investments. So, what is portfolio? So let's understand what is portfolio. A portfolio is nothing but a collection of wide range of assets. And it is owned by investors like you and me, who actually buy these assets by spending their hard-earned money. Now, these assets may include stocks, which are nothing but shares from stock market, bonds, mutual funds, fixed deposits, debentures, gold, silver, real estate, and so on. So, investors are supposed to spread their investments across investment options. This means that you should not actually go with only one kind of investment or two kind of investment options. And let's understand why in the next slide. Why do you need a diverse portfolio? Now, you should understand that keeping all your money in a single investment is too risky. Yeah. So, for example, if you are keeping all your money in equities, it is risky. You will be actually risking all your money onto market risks. Sometimes the market may go up and it looks awesome to see your investments shooting up in returns, but the next day when the market is down, it may literally give you a heart attack. Your shares are down and investment returns which were reaping you 20% or 30% are actually into minus 20% or 30% or even more. Now, another reason is liquid versus illiquid assets. Now, if you are putting all your money in illiquid assets, you may face trouble in encashing illiquid assets easily. So, for example, putting all your money in property, homes, so basically property, nothing else. So if you are putting all your money in property, it's a good investment option, but it is illiquid. You will not be able to get quick cash by selling it. Probably it may take time, and you may not be able to get the required sum when you need it. As opposite, if you are just liquid, this means you are not having an investment like property. You may lose on fat returns like property price appreciation. So for example, in 2010, if you would have bought a home in, say, Gurugram for 50 lakhs, probably by 2021, you would have reaped a price of 1.10 CR on the same. So it's about losing your money which you could have earned in property investments by not investing in property. Another one is investing at one place makes you lose potential earning opportunities. This means if you are putting your money only in mutual funds, you are losing a steady income return from fixed deposits. Or on the contrary, if you are putting all your money in mutual funds, you are risking potential earning opportunities in equities, and vice versa. Now, majorly keeping deposits make you lose market returns. So that's what I was just explaining. If you are putting in all your money in fixed deposits, recurring deposits, you are earning a decent return of 6% per annum. You may lose on the 10% or 20% or 30% market return in encashment by not putting your money in equities. And similarly, if you are only going to put majorly in equities and you are lured by the return pattern in equities, that makes your capital vulnerable to market risks. So if I as an investor choose to spend all my money in equities, I am buying shares of Reliance, shares of ITC, shares of HCL Tech, Infosys, all blue chip companies. But every market goes down sometimes. When it goes down, it may literally give me goosebumps to see, where my investment stands today vis-a-vis when I invested it. You may be losing it, you may be gaining it. Okay. Now, it is exactly like risking all your eggs in one basket. If it falls, all your eggs are gone. So why risk all your investments in one investment option? So there's a problem. What needs to be done? Now, luckily, we have got some steps which we can do to mitigate this specific problem or risk. As an investor, you need to identify your income and saving pattern. Now, what is the amount of income you are generating every month? And I'm not talking about income from equities or your savings, but income from your revenue earning activity. For example, from your business or from your job or from your profession or whatever way you are generating income. So, how much income are you generating? What is your what is your income outlook for the next 5 years or 10 years? And what is your savings pattern? What is the percentage of savings you are doing on your regular income? Next, identify your investment goals. Just blindly investing in stock markets, FDs, mutual funds, or whatever investment options isn't the right thing every time. Or I would say rather, isn't the right thing at all. You need to understand what are your investment goals. What do you need to achieve by investing today, 10 years henceforth? So for example, 10 years down the line, you need to fund higher education for your daughter. Or 15 years down the line, you want to buy a bungalow in a posh area in Gurugram or in Delhi or in Noida or in Bangalore, whatever, wherever you reside. Learn about investment options like what are deposits, what is equity, how it works, what are mutual funds, how it works, PPF, and so on and so forth. Create a balanced portfolio depending on your investment goals. So for example, if you are earning an amount with which you are managing your household and probably you are saving 20% of your earning per month, you can save 20%, then you should be very particular about preserving your capital, because the amount of dispensable or savable income in your hand is lesser. So what you should do, you should choose that you should preserve your capital. You should not risk your capital or the 20% of savings which you can do every month. So you invest accordingly in options which are safer or less riskier, like mutual funds, like deposits, like PPF. On the contrary, if you are able to save 50%, 60% of your income, or even more than that, then you may choose to diversify it further, like having 20% of your savings in equity, 30% of your savings in mutual funds, the rest 30% in PPFs, and so on and so forth. So these are just numbers for an example, friends. I would suggest you to learn it by yourself, understand your own investment goals, and then create a balanced portfolio. You may want to take advice of your investment advisor as well. Now, one more interesting thing is investing and reviewing and rebalancing your portfolio periodically. So you should actively see every month, or rather every 3 months, what your investment has reaped, right? And if there are any other investment options which are working well, where you should try to reinvest your money. So this is what basically need to be done to mitigate that investment risks. Now, benefits. I would talk about benefits of portfolio diversification. Why you should not put all your eggs in one basket but different ones is that you manage your risks against market volatility, against capital erosion, and against your capital blockage against illiquid assets as well. Secondly, you optimize your returns, in terms of uninterrupted earning. So for example, your equity is down and you are not able to generate money. You keep your equity, hold on to it, but your fixed deposits are earning a return for you. Your bonds are earning a yield for you. and it also gives you liquidity. So if you are having a decent portfolio of property, a decent portfolio of mutual funds, a decent portfolio of fixed deposits or any deposit, you will be able to liquidate your liquid assets quickly and then make use of that amount of money you need for. Also, the next is capital preservation. So you are not risking entire capital in one go, but you are preserving some amount of capital, and then depending on your investment goals, you are also rebalancing and optimizing your investment portfolio. And the third one is future proofing. You are future proofing yourself against market risk. What may happen tomorrow? You can switch between your assets as needed in the future if you have a multiple investment strategy, and you can hold on to an asset for longer durations in case that asset is not working out for you, but you know that it is going to work out. For example, equities. So today, if I have got 100 shares of HCL Tech, HCL Tech has done a great bull run since last year, and now my asset is not reaping a good return. The share is going down since last 1 month continuously. I know that being a blue chip company, this HCL Tech is going to give me a decent return, but all I need to do have patience as a long-term investor. So you can hold on to assets because you have other assets at your disposal which you can use to meet your current finance needs. So I hope friends, you are able to understand what I am trying to explain you with this specific presentation. Now, a few options which you can exercise to have a balanced portfolio, and with a caveat that you need to also discuss this with your investment advisor, is that mutual funds and SIPs. You can go with MFs and SIPs for a low risk market linked return. So when the equity market goes up, your mutual funds are going higher, the mutual fund NAVs are going higher, and you're earning a decent return, maybe 20%, maybe 30%. Yeah, you can choose deposits for an uninterrupted income at a lesser rate though, but yes, there is no risk involved. If you are putting your money into a fixed deposit in a bank, you are earning 5.9 per annum, but that is guaranteed, so you are not risking your capital. Third one is PPF, public provident funds. That is for a futuristic savings and reasonable interest rates. You may be earning around 8% on a PPF, and you have locked in of 15 years. So you can decide how much amount you would be able to reap by investing 1,50,000 per year in PPFs at the rate of 8%, and then accordingly decide how much amount you would want to put in PPF. And also you need to put in the tax saving element in picture as well, because PPFs, some mutual fund plans like ELSS, equity linked savings scheme, brings you tax benefit as well, so that also you need to consider. Equity is definitely the most rewarding ones, but the most riskier ones. You can earn dividends and a greater risk to reward ratio. You can enjoy fruits of the market when the equities are on the bull run. You can go for debts and bonds for a safer investment option than equities. So now friends, this is what I wanted to bring to your knowledge today, that having a balanced portfolio gives you an edge over a single or a few portfolio driven investment strategy. So I hope you liked this topic, and I hope I have added to some of your knowledge. And so let me know, what do you think of this video? Comment what do you think, what are the best options for a balanced investment strategy. Also suggest options which can earn reasonable reward with relatively lesser risk to help your peers. And do like, comment and share this video, and subscribe to our channel. So with all the love and respect for you, thanks for watching this video.